All right, everyone. Well, we are right at the hour, so I'm going to make sure to get started here. I appreciate everyone rolling in for our first installment of the Financial Wellness webinar series for 2025. Hopefully everybody had a great, holiday stretch here and is welcoming the new year with a positive mindset. So last year we had a lot of success with these. We received a lot of positive feedback, some constructive feedback. We're trying a couple different time slots this year to see if we can get more people engaged during the lunch hour. But regardless, all of these webinars are recorded, so we are slowly building up a little archive for our friends over at Advocate Aurora, as well as Children's Hospital. We are rolling out a couple new employer bases this year, but they're still in the works. So without further ado, why don't we jump into our webinar for today? We're going to be covering financial wellness. So this is kind of an overall presentation. There's a lot in this one too. So if you can't stay for the whole thing, don't worry, everybody will receive a recording within a day or two, for sure, prior to the weekend. So I'm just going to kind of jump into it. Let me give you a little background of who I am for those of you that haven't been on any of these webinars in the past. We've been doing them for probably a year and a half now, I think. So my name is Lucas Amell. I work as a financial planner and financial educator in the Milwaukee, Wisconsin area. However, we're servicing people all over the country. So do a lot of work with folks down in Illinois specifically. We're doing a lot of work, ironically, with people in California. Hope prayers out for them with all the wildfire stuff going on right now. But I don't want to spend too much time on me. I know I'm really interesting, but that's not why you're here. I've got a background in finance, about 8 years in the industry. I'm a managing partner on a team here in the Milwaukee office. We're overseeing about $250 million in assets. Have a big background in tax planning, estate planning, retirement planning. And that's why, your employers have asked me to offer these presentations for all of you. I've been in the industry for a long time. I've seen, a lot of what can go right for folks. And unfortunately, I've seen a lot of what can go wrong, right? And one of the biggest things that I find in those two things is, when stuff's going wrong, it makes the world of difference if you were proactive with your planning. So that's why we do these workshops. We're trying to put out as much positive information for all you guys to make constructive, proactive financial decisions, right? So enough about who I am. Who I'm not, I'm not a lawyer. I am not any kind of a CPA. So everything that we're going to be going over today, it is not to be considered direct investment advice. It's just general informational in nature. Okay. So without further ado, why don't we kind of just dive into this? Let's really understand, what we mean by financial well-being. Okay. So financial well-being, as defined by the Consumer Financial Protection Bureau, means these following things. I kind of like to call them the 4 pillars, and all of which, we're going to go into greater detail for. Okay. So first and foremost, having control over our day-to-day, our month-to-month finances. So this is basically budgeting, right? Well, I'm going to do a whole presentation on budgeting next month. So that'll be a really good one. That's a huge thing for people. I meet with people, tens of hundreds of families every year. And it's astounding how few people understand what's going on with their cash flow, right? So that's a big one. The second pillar here of financial wellness, having the capacity to absorb a financial shock. Thirdly, being on track to meet our financial goals. And then fourthly, having the financial freedom that allow you to make the choices that you want to make, that allow you to live the life that you want to live and enjoy it. So as I said, we're going to dive a little more into these. I know there's a lot of breadth to this presentation, so sorry if it seems like I'm going fast up front. So when we're looking at it, like I said, I'm going to kind of break this out into those 4 pillars, kind of hit on some of the important things and how they're applicable to it. But let's kind of do an overview of the primary topics I'm going to be talking about today. Okay, so first of all, we're going to talk about savings, right? Everybody needs to save no matter where you are on your journey, unless you're spending it down. So this is often going to be the foundation of all of our financial strategies, right? So next, we're going to talk investing. So many people out there may be apprehensive about investing, especially in days like today. You know, I'm giving this talk, January 15th of 2025. We've been seeing a lot of volatility in the market, right? So a lot of people are concerned, hey, is now a good time to be investing? When should I start? Should I stop? So we're going to talk a little bit about that. I do have entire presentations where I go into depth about investments and investment management as well. So then, thirdly, we're going to discuss protecting what you've worked so hard to achieve. So this can be through life insurance. This can be through financial strategies. We're going to go over that a little bit as well today. After that, we're going to talk retirement planning. I think, you know, I'm studying right now for a designation to become a certified retirement income specialist. And one of the biggest things that it talks about all the time throughout the course curriculum is that everybody is ready to start saving for retirement. There's not a certain period of time or a certain age or a certain income that you need to achieve to start planning for retirement. You know, the best time to start planning for retirement realistically was yesterday, right? The second best time's today. So we'll talk a little bit about retirement today. And then lastly, we'll talk a little bit about estate planning. So many people, I feel, think that estate planning is only for the ultra wealthy, etc. But in reality, it's not. Estate planning can be used as a roadmap for how all of your assets, all of your debts, and any kind of tax liabilities, they're adjudicated after your death, meaning how is that all getting passed on to the next generation, to charities that you support and believe in, you know, causes that you stand behind. Okay, so with that, why don't we jump into this? So saving, right? And a lot of this, there's a lot of information on this presentation, just to be clear, because it's an overarching presentation. All of these different bullet points that I'm breaking out throughout the course of this year, we're going to kind of almost dedicate an entire presentation to them. So I'm going to be talking a lot. So when I need to take a break for water, please just bear with me. Okay. So saving money, right? It is the foundation of every financial strategy that you or your loved ones are ever going to have. Okay. So with savings, like anything in life, you're going to need to have some kind of goal for yourself, right? So most of you know how to set a savings goal. So you need to identify the cost of the things you want, whether it's some kind of down payment on a home, down payment on a car, perhaps it's a vacation, something along those lines. Well, you need to determine when you want this thing, what it costs, whether it's today, whether it's tomorrow, whether it's 5 years from now. You know, that's the timeline that you're going to be playing with. When you have how much it's going to cost and when you want it for, you know, it's basically just a simple calculation. Hey, there's the total amount divided by the number of months or the number of years in your timeline. That's going to tell you how much you need to save each month to reach your goal. Now, it can get a little more complicated. There could be rates of return, stuff like that. But this is at least going to give you a realistic guideline and help break that goal down into something that's a little more manageable and realistic, right? So that's one tried and true way to reach a savings goal. Unfortunately, life is not always so cut and dried. Priorities change, and of course, there's outside forces that can derail even the best laid plans, right? So instead, you might consider even setting a savings goal as a percentage of your monthly take-home pay. So one suggestion would be, and this is kind of a rule of thumb in the retirement world, maybe save 10% of your monthly income for retirement. Okay, so this is a little easier to digest sometimes because income fluctuates, especially based on what kind of career you have. So include this savings amount as a fixed expense line item on your monthly budget. right? So we never want to deviate too much from it. If we really have a firm goal that we want to accomplish, consider it a fixed expense and hold yourself accountable to saving in that way. So that way you're at least sure that you're setting aside those savings every month, right? So once you begin to save that 10% of your income each month, you can start kind of divvying that up or allocating it to, the different amounts based on what your priorities are. And those priorities can change over time, and that's okay. But in terms of saving, a really good rule of thumb is if you can save 10% of your income, you're in a pretty good spot. You'd be surprised at how much that adds up over time. So an example here, it's critical that everyone has an emergency fund. That was technically one of the pillars that we talked about initially, having some kind of fund to absorb financial shock. Well, an emergency fund is a huge thing. So if you do not have an emergency fund, which typically that's an amount equal between, anywhere between 3 to 6 months of your income, building one should be a top priority for you to get started on. So hypothetically speaking, if you can allocate a larger portion of your monthly savings, even 50%, which I know is a stretch in today's world, but if you can set this aside to your emergency fund just to build that up in the short term, your financial wellness goes through the roof, right? Because everybody knows that rainy days happen, okay? Cars break down, tires pop, furnaces break down, roofs start leaking. Having a fund that you can tap into in those rainy days, or, corporate layoffs happen. You don't want to tap into your retirement accounts most often, especially if you're below the age of 59 and a half. You're going to incur substantial penalties. You're going to have to pay taxes. So having an emergency fund to help float you through those uncertain certainties of life is hugely important. Okay. So continuing on, once you kind of have a savings goal in mind, you need to put a plan into place that's going to help you reach that goal, right? So as we mentioned a moment ago, if you can include your savings as its own line item on your monthly budget, you're going to be in really good shape. It really helps enforce the savings. I find that planned or forced savings is the best way to do it. Humans have this really funny tendency that if we see it, we spend it. If it's in the account, it's not in the account by the end of the month. If you're forcing yourself to save, it really, really can hold you accountable to yourself, right? So make sure when it comes to savings, you consider this pay yourself first approach or mentality. It's simply just a way to save, kind of like using a direct deposit. So this is sort of what I was saying, is that when your paycheck hits, that money automatically gets redirected to another account, whether it's a Roth IRA, some kind of Robinhood account, or even just an alternative bank account that you don't have a debit card for. It's this out of sight, out of mind, reduces you from just kind of burning a hole in your own pocket, right? So remember, this is critically important, that saving does not have to come exclusively from your income. Okay. Now it can and should also come from reducing expenses. Now think about what you're spending, your income on every month. Are all of those expenses necessary and, needed? So a lot of you probably smirk where it's like, well, no, I get a $7 drink at Starbucks like every day. I probably don't need to. I get that once in a while you need to treat yourself, but a lot of these things that we're spending money on a regular basis really add up. One of the big ones that I see when I walk through budgeting with people and trying to find new areas to save is eating out for lunch. I know that we live in a busy world, and sometimes you don't always have time to make yourself a wholesome lunch meal, and ordering Uber Eats is just a good decision, time wise. But look at how much it adds up over time. And most of you know it and electively choose to not look at how much it costs. But, there's a lot of ways that you can save money by just spending less, not by saving directly from the income. So It's really, really important. You know, we've mentioned your monthly budget a couple times already. Your monthly budget is kind of the best way for you to identify expenses that can be eliminated and could be used for savings instead. So when you're creating a budget that includes savings, keep this simple perspective in mind. You know, a budget is not any kind of a restriction on your spending. Okay. Instead, a budget is just helping you to spend more on what you really want. It's to help you categorize and have an understanding of where your money is and where it's going. Okay. If you need help setting up a budget, reach out to me. We've got a bunch of free organizers and budgeting like walkthrough materials that we can send you. Doesn't cost anything. It just takes time to kind of get them put together. Okay. So continuing on our saving talk, you know, this is an important thing. You know, a lot of people ask me like, okay, well, when should I start, right? So a lot of you might be thinking, okay, well, saving can wait. You know, I've got plenty of time, and you may be right. But, you know, when it comes to compounding interest, having plenty of time is much more your best friend, right? So Albert Einstein called compound interest the eighth wonder of the world for a reason. Okay. So when we put it simply, you know, compound interest is the addition of interest. So first to the principal of your savings, but then thereafter it's money that's being made on top of the money that your money's already making. So it keeps growing and growing. So it's the growth of growth on top of growth, right? So to illustrate how that works, let's just kind of compare two people, right? We've got our blue line and we've got our green line. Okay, so person one, represented here by the green line on the chart, they put $10,000 into a compound interest bearing account. No other principal was added. Okay, so they just added $10,000. They got an average 5% annual rate of return, and the value of their account by age 70 would be just over $104,000. Okay, now person number two, okay, they, on the other hand, took that savings can wait perspective, right? And they didn't start saving until they were age 40. I'm sorry, so person one started earlier, right? So in person two, they have the similar amount that they had as person one, but they needed to save a lot different, right? So what this person did is they set aside $125 each and every month for 30 years. And even with that, they're still a little shorter. So in reality, for the person that dropped down the $10,000 way back when, compared to waiting later and trying to catch up to that person, person one spent $10,000 to get to that same 100,000. Person two ended up spending 45,000. And that's just because the other person had a longer window of time for their money to be working for them. Okay, so this is why it's really important, if you can, to start saving at a younger age or whenever is sooner, even if it is, say, $20, $50 a month. That thing can really, really, really add up over the long term. And most likely you're spending it on dumb stuff you kind of don't need or isn't going to provide long-term fulfillment anyway. Okay. So this is another thing that I get asked about all the time. So I wanted to make sure to include it in here. So before we move on, I just want to have like a quick word about debt, right? So I know many of you probably are feeling the effects of debt, whether it's, you know, purchasing a home recently, especially with where interest rates are, or, you know, you just recently graduated college and now you've got your student loans to deal with. So a lot of Americans are in the same boat. Don't feel like you're alone. Okay. Now, paying off debt, it is critically important, right? You do not want that interest growing against you. You do not want it growing in a way that, you know, it's going to be something that becomes unmanageable. However, as I've said several times now, reaching your savings goals it's going to be a balance between these competing priorities. Okay. And with that, you know, some of these competing priorities is often pronounced in regards to debt, right? So you may have heard some financial pundits say out there that you should focus all your effort on paying down debt as soon as you can, and then you can start savings. So what you choose to do is entirely up to you. However, it might make sense for you to kind of strike a balance between the two of them. Okay, so you can think of it this way, right? You can choose to be debt free within a certain period of time and at the end potentially have no savings. Or you can take a little bit longer to pay off your debt. Yes, you'll pay a little more in interest, but at the end of that, you might find that you're in a much more solid financial state compared to if you focused everything on paying off the debt, because you'll be able to build up some kind of a financial cushion as you're paying down those debts. So thinking back to those previous slides that we had discussed the effects of compounding interest, if you focus only on your debt and paying down your debt and not adding any kind of savings, how many years of compounding interest are you actually missing out on? You're going to be, back in our example here, you're going to be much more similar to that green person, where if you have a target for your retirement of, say, $1 million, and you start saving at 22 versus 40, that 40-year-old is going to need to put a considerable amount more on a month-to-month basis to hit that $1 million by whatever age they're trying to hit it at. So I typically see that it's a bigger benefit for people to strike a balance between paying down debt as well as saving for their future. And if you have questions on that, reach out to me. We can run kind of break-even analysis at no cost to you, just to show you, hey, here's an optimal way for you to do this, and here's what you could expect by the time those debts are paid off in terms of like money you would have in a 401k or a Roth IRA, something like that. Okay, so we'll move away from saving. What do we do once we have money saving? Well, most of you probably know it's best to not just sit around in a bank account, although some high yield savings accounts, over the past year or two here have been very attractive. We want to get that money working for you, right? You don't want lazy money. You kind of want to put it on a treadmill, hopefully see some growth by participating in some kind of investment opportunity. So when we talk about investing, we're talking specifically about putting your money into financial instruments. So that can be stocks, that can be bonds, that can be mutual funds. Also included in the discussion here, we're going to be talking about cash and some cash equivalents, such as like certificates of deposit or money market funds. For a lot of people that don't understand the financial world, it's relatively overwhelming with how many different investment vehicles are out there. So we're going to try to simplify it for you, shed some light on the ones that are legit, not legit. I don't think I talk about not legit ones, actually. We're going to talk about the legit ones, okay? So we won't be getting into too much detail about all the investment vehicles. We're just going to kind of go over them. However, just make sure that you understand what we're talking about when we mention stocks, okay? So stocks, also called equities, we're talking about purchasing a share of ownership in a company, okay? So these stocks or shares, they're issued by companies to raise capital, okay? You can buy and sell stocks at your own discretion in the open market, right? So a stock is like you own a share in Facebook or Tesla or McDonald's. You can buy it. Most large corporations have publicly traded stock that you can own and participate in the potential growth of those companies, right? So then when we're talking about bonds, we're talking about, a type of investment that's issued by, a municipal, a government, or some kind of corporate entity. A bond is more of like a promise. So the money an entity receives is kind of a loan, right? So they sort of agree to a fixed time frame and a fixed rate of return with you. Typically, on average, you see less of a return from bonds than you do stocks. However, there's more of a, I can't say the word guarantee, but there's more confidence with your rate of return when it comes to bonds. However, the rate of return is less high because you're assuming less risk as you would with stocks, right? And then mutual funds, that's kind of the third one here that we kind of talk about When we're talking about mutual funds, we are talking about investment portfolios that are pooling money together with other investors, kind of purchasing a big block of different stocks, different bonds, different types of investment vehicles. You kind of buy one share of the mutual fund, but you're owning multiple stocks and bonds all at once. Okay, so first, regardless of what kind of investment vehicle you choose, it's very important to know why you are investing. Okay, so what are your goals? What are you trying to accomplish? To answer this question, start by thinking of what your savings goals are. If we think about it, the money that you're going to be investing will most likely be money that you saved. Okay, so what are you saving for? Why are you doing this? Start there and then speak with some kind of trusted financial professional about your saving and investment goals, and they can help you develop a plan that will help you achieve these goals. Okay. So, second, after we understand why we're investing, second, let's understand what our risk tolerance is. Okay. So, there's so many tools that are out there where you can find online that will help you better understand your risk tolerance. We'll discuss it a little bit more in a second. Next, thirdly, we need to be realistic with our investment expectations. Okay. Whatever your goals and objectives are, know that you're probably not going to see a return on your investments right away, right? So you can't put money aside and expect in a month it's going to be up 10%, right? There are realistic metrics that you kind of need to hold yourself to. And then the same thing is too, I hear people all the time and they're kind of joking, but they're kind of not when they give me their money to invest. They're like, Lucas, put this somewhere where I can make money but not lose money. Like, well, how much do you want to make then? Because everything's a trade-off, right? There's this risk reward trade-off when it comes to investing, and it's very, very important that you know what that is. Okay, so of course, in that time, there's going to be market downturns and stuff like that. But anyway, so we'll keep moving here. So risk tolerance, I kind of brought this up. It's complicated, but when it comes to investing, this is probably one of the most important things that we want to talk about. So a risk profile is going to help you kind of determine what level of risk is appropriate for an individual investor. So if you aren't sure what risk level that you're comfortable with, take some online surveys that are going to measure your risk tolerance and give you a general idea of which, investing approach might be best for you. So on the screen here, we can see the spread. Now, nobody fits directly into one of these. Usually you're somewhere on the spectrum. Okay, so of course, like the more aggressive you go, the more stocks you want, the less bonds you want. The more conservative you are, the more bonds you want, the less stocks you want. Now, typically, we still see a benefit, no matter where you are on the spectrum, of having some degree of a balance between stocks and bonds. You most often don't want all stocks. You most often don't want all bonds. They play together very well. So there's some other factors that are going to help determine risk tolerance. Okay, let me get some water here. First of all, is age. Okay, so when we're determining risk tolerance, we need to really think about, okay, well, how old are you? How far from retirement are you? So how long before you're actually going to need to use the money from your investment is going to play a huge part in how little or how much risk your portfolio should, in theory, have. Okay, second is risk capital, we call it. So meaning the money that we're investing, if it's lost, how much is that going to adversely affect your financial well-being in the short term, in the medium term, and the long term? Next, how much do you actually know about investing? This can be a huge factor in your risk tolerance, because not having a solid knowledge base makes determining risk versus reward very difficult, because people really don't realize that their risk tolerance was a lot lower than it is, unfortunately, until they see it tested by, having a substantial negative a negative turn in the market, right? Because we can't control that. Okay. So lastly, what's your own personal comfort level, right? So this is going to play a huge role in risk tolerance, because even if somebody in theory should have a riskier portfolio and they lose sleep at night if their portfolio went down 2% in a day, maybe that's not how it should be set up. Your investment shouldn't keep you up at night. I would say the biggest thing when it comes to that, or preventing that from happening, is having a sound education behind why you are invested the way you're invested. Okay. So there's still plenty of other considerations. This, of course, is not all of them, right? You need to know before you determine your risk tolerance. So consider seeking the advice of a trained financial professional or a fiduciary financial professional that can help you assess your personal risk tolerance levels and make sure that your investments are in alignment with what you would be comfortable with and what would be appropriate in relation to your goals. Okay. So it's also important to note that your risk tolerance may change over time and with different circumstances, right? So generally speaking, your tolerance for risk is often going to be driven by your age as well as your proximity to retirement. Okay. So as your age increases, your investment time horizon shortens, right? So where you might have less time to make up for these market losses, so your risk tolerance is slowly going to, in theory, go down over time for most people. Okay. Next, asset allocation. So this is huge. We talked about risk tolerance. Once you identify your risk tolerance, well, what does that mean? How does your risk tolerance play into, how are you actually investing? Well, what we do is we call that your asset allocation. Okay. So your asset allocation is the way that your portfolio is going to be divided among different types of investments, right? So you can call this your portfolio makeup. Your risk tolerance will help you determine how much of your portfolio should be invested in equities, your stocks, your bonds, your cash equivalent. This is where annuities come into play. So the pie chart here is kind of showing a moderate portfolio, right? We've got a good chunk in cash. We've got a good chunk in equities. We've got a good chunk in bonds. If anything, that's actually a lot in cash, in my opinion. But, let's take this kind of a step further here, is by having this mix of stocks, bonds, and cash equivalents, whatever that looks at, that's what you have, in essence, a diversified portfolio or diversified financial strategy for yourself. Now, this is very, very important, specifically as people near or enter retirement, okay? Because when you're in retirement, your investment game changes dramatically. Okay, because you're not no longer investing just purely for growth to try to drive up the account value. You're investing for income. All right. And that's when the game changes, is because no matter what, the market's still going to do its little zigzag, right? It's some days it's going to be up, some days it's going to be down. Some years it's going to be up, some years it's going to be down. However, the investment game changes dramatically when you need money from your portfolio. Okay. If the market's down substantially and you still are living on a fixed income as a retiree, we do not want to draw your income from a depressed asset source. We want an alternative space within your investment portfolio that we can draw funds from to allow the depressed assets time to recover. That's its own presentation. I just wanted to talk about it. So simply put, being diversified is going to mean that we're going to combine a variety of assets, seeking to reduce risk based on what's happening in one way versus the other, outside, external of the portfolio. So this strategy works well because different asset classes or different categories of investments are not going to be moving in the same direction at the same time, right? One may go down in value while another one's going up in value. That's why we want this to be diversified. Okay, so a common path towards diversification to reduce risk or volatility is not only to invest in a variety of different assets, but also to invest in different categories within a particular type of asset. So this can include not only investing in different types of stocks, for example, such as there's income stocks, there's dividend stocks. Actually, that's the same thing. There's tech stocks, there's defense stocks, there's health stocks. There's so many different ways to invest within these broad categories. I will be doing a presentation on investing in March. So stay tuned for that one. That'll be a good one where I can, spend a lot more time going into these. But, one funny acronym that they that they came up with for me was called DAD, right? So determine, when it comes to investing, remember DAD. Determine your risk level, allocate your investments according to that risk level, diversify within your allocations. So determine, allocate, diversify. Thanks, Dad. Sorry, next one here. So some other long-term investments. I'll go quicker with this part because I know we're already, what time is it? We're already hitting 40 minutes and I still have a lot to talk about. So some other long-term investment options that I didn't really hit on, but like I said, I'll glaze over these. Real estate can be a tremendous investment, whether it's your own personal property, investment properties, whether they're income related or just buy and hold for flips. College funding, we will do a whole presentation on college funding this year too. Some big things with college funding is just saving into like a 529 plan or even permanent life insurance. Those are some other investment options. I won't talk too much about that today. So protection, this is another big thing with financial wellness. An important part of your overall financial well-being is going to be to take the necessary steps to protect your assets. Okay, so this can be your home, your car, and of course yourself from any kind of liability or unforeseen circumstances, right? So most of us would not be able to foot the bill outright should a fire, unfortunately, or tree damage our homes. So if we were found responsible for harming somebody in a car accident, all of these things can be really, really expensive. That's why it's extremely important to make sure that you have insurances in place, right? So, some of the big things when it comes to property and casualty insurance, having efficient car insurance, having home insurance, renters insurance has become a lot more popular lately. I even see people with pet insurance. Unfortunately, I've seen a lot of people without pet insurance, and they'll have multi-thousand-dollar medical bills from the veterinarian. There's a lot of ways that you can protect yourself that are out there. That's the whole purpose of what insurance is. It's pooling together money. So when something happens to one of the policy's owners, they can kind of tap into that pool. Insurance has been around for a long time. I mean, in most states now, I think you're legally required to own auto insurance. If I was president, I would make sure that everybody would have life insurance. That should be a requirement, but unfortunately it's not. It breaks my heart to see all these young people getting hurt in accidents, overdosing on drugs, and then their family needs to open a GoFundMe page to bury them when they could have been spending $8 a month for $100,000 life insurance policy as a kid. Whatever it is. It's important. All right, health insurance, also important. You guys should, if you're on this call, you probably have it because you're an employee. Health insurance, hugely important. I'm not going to spend too much time on this one. You should have it. You should understand why you have the plan that you have. I'm a big fan of having high deductible plans purely because they allow you access to an HSA or a health savings account where the money, like in my opinion, nobody should be paying for health insurance or health costs with after-tax dollars. All right, meaning that money with an HSA, if you have one, definitely leverage it. The money that you put into a health savings account, you get a tax deduction on. It grows in there for you tax free. And if you're using it to pay for qualifying medical expenses, that is also tax free for you. Like I said, I do not think that anybody should pay for healthcare costs with after tax dollars. If you have questions on that, let me know. Like I said too, life insurance, this is hugely important when it comes to a protection side. There's the amount that you get through the employer, but life insurance, it's a financial product that, in exchange for timely premium payments, it's going to pay a death benefit when the person who is insured passes away for whatever reason. Okay, with life insurance, there's not a lot of contingency clauses unless they're stated very clearly upfront in the contract. So those insurance benefits, they're paid to the beneficiaries, and typically those are completely tax-free. So it's a very, very good way to make sure that you're protecting yourself and your family in the event that, hey, if something happens to you, your income's no longer around, you're really, really going to be able to look after them, and still be able to accomplish some of those goals, whether it's college related for your kids, whether it's retirement related for your spouse. That's hugely important that you have some type of life insurance for the people that depend on you financially, right? So when you're considering purchases of life insurance outside of the employer, just know that there's two main types. Okay, there's term insurance, which this is going to provide a death benefit protection for a specific number of years, right? So we'll call them a term. This is generally the cheapest that you're going to find out there. The most popular policy types are 10 and 20-year life insurance policies. Some companies offer 30 or beyond. You can look at term insurance kind of like renting a home, right? So it's like renting insurance. You pay to have the policy for a specific period of time. Once that policy expires, you do not own anything. All of your premiums, they're gone with the wind, fugazi, right? It's like renting. So the other type of insurance that's out there, it's called permanent life insurance, right? So permanent life insurance, as it sounds, it is permanent, okay? So the life insurance coverage is going to last your entire life as long as you are paying the premiums and do not allow your policy to lapse, okay? So some permanent life insurance policies offer premiums that are guaranteed, that they will not increase over the life of the policy. Some, the premiums do increase over the life of the policy. This, I'll just say it because I get asked it like 15 times a week because of TikTok and social media is like these IUL and VUL policies that are out there that have gotten really popular because of TikTok. That is one, I'm not a big fan of them purely because of the reason that the cost of their insurance, so technically the premium increases year over year. So when they're being illustrated, people will illustrate that the performance within them is super, super good. Unfortunately, I'm having these phone calls with people that bought them in their 30s, and I'm having the conversations with them today. And, the cost of insurance has spiked so much over the course of the policy that now they're getting shoved out of them. So just a word of caution with them. I know they're getting popular. If you have questions or want me to break one down for you, I'm more than happy. So just know there's two main types of insurance when we're looking at it, term and permanent, right? Disability. This is another thing too. We talk to people about these all the time, right? So let's start our discussion on disability income insurance by considering that your ability to earn an income may be your most valuable asset. Okay, so here's a simple exercise just to quantify what I mean. So take your current salary and multiply it by the number of years until you retire. So illustrating what I mean, here's a hypothetical example, right? Person, 30 years old, they're making $50,000 a year, and they're 37 years away from retirement. Okay, so $50,000, their salary, multiplied by 37, the number of years until they're going to retire, equals $1.85 million in cumulative income between now and retirement. Okay, now keep in mind, this is just a hypothetical example. This doesn't have anything to do with how they're going to receive raises over that period of time, salary increases of any sorts, bonuses, nothing. It's just saying, hey, you make 50 grand now, you make that for the next 37 years. That's almost $2 million, right? So now it's your turn. Take a moment, use this formula, current salary multiplied times year to retirement, to quantify what is the value of your future income. Now compare that number to the value of any other assets that you own, whether it's your home, whether it's your 401k, anything. Usually your ability to earn an income is the most valuable asset that you have. So now a few moments ago, I was discussing how important it is to insure your home, insure your car, against any kind of losses. So wouldn't it not make sense to insure your most valuable asset against those same kind of losses? So specifically, ensuring that your ability to earn an income is there throughout the course of you and your family's life. Now, of course, you might assume the odds of becoming disabled for an extended period of time are low. However, that may not be true. So a recent study, and it's not super recent, it's been out for a long time, but they keep re-upping it just because it's becoming such an issue. According to the Social Security Administration, for today's 20-year-olds, the risk of becoming disabled before the age of 67 is 1 in 4, right? So almost 25% of people between the age of 20 and 67 have to file a disability claim, a long-term disability claim. So what are our options, right? So there's several options that are available to you for, replacing income in the event of disability. The most popular, and all of you on the call should automatically be enrolled in this, is group long-term disability insurance, otherwise known as GLTD. This is available through the employer, so it is a benefit that most of you have. Typically, it's for 50% of your income. However, when that 50% kicks in, that is taxable. Okay, so say you make $100,000 and you file a disability claim, they're going to pay out $50,000, but then that $50,000 is taxed at the federal level, at the state level. So usually you're dropping from $100,000 of income more down to something like 35 or something there. So it's really important that you understand that and address, if it's important to you, this disability gap. Okay, so meaning, hey, can I cover more of my income above that 50%? It's very important to people. I see people, especially in the medical world, because they're dealing a lot of times with people where it's like, oh my gosh, this person's never going to be able to be normal again. I see a lot more people in your field kind of view that as important. So I don't want to spend too much time on it. All these things I feel like I could talk about for like an hour. So if you have questions, just reach out directly, but I want to make sure that I can cover the bulk of what we're going through today within as close to an hour as I can. Okay. All right, retirement, everybody's favorite topic. Okay. So much like setting goals for saving as well as investing, you are going to want to devise a set of objectives that help you prepare your life for after working, right? I know it's hard to imagine for some people. So retirement is not what it used to be. People nowadays, they're living longer. Some are working part-time into retirement. A lot are working part-time into retirement nowadays. Many people are kind of considering retirement this next phase of life, life after full-time work. It's almost reshaped, no longer seeing it as retirement, but it's like life after my full-time career, right? So every person, their situation is going to be a little different, and everyone's going to have a different experience during this period. Most everyone needs to consider kind of the same question up front, right? So what do I want my retirement to look like? Take a little bit and ask yourself that. If you're watching this recording, pause the video and ask yourself, what do you want your retirement to look like? All right, that's all the time I got. So let's start by thinking about this question. Like, okay, well, where are you gonna live? These are some questions that you need to ask yourself as you're starting to frame what retirement does look like, right? So one consideration in retirement is, to contain costs. So where you're living is going to have a major impact on your retirement finances. If you're planning to stay in one place, whether that's where you live now, as a lot of people do, you'll need to understand, what will that entail financially? For example, are you going to be able to afford future maintenance of your home, both financially and physically? That may be required for your new home. This is one thing that I see a lot of is, when people are retiring or nearing retirement, downsizing or even moving out of homes that have 2 stories or long, steep driveways because they don't want to fall. I see that stuff all the time. Next, where are you going to live? Well, how are you going to spend your time? The answer to this question oftentimes is another question, like, what will be the most important thing to you in retirement? This may seem at first to be a difficult, question to answer, but it may not be. And that's because many of the things that you're going to value and enjoy in retirement may be the same things that you value and enjoy today. What is the most important to you today? Chances are these things are still going to be important in retirement, but you need to start shaping it together. I see a lot of kids spending more time with their children and grandchildren. I see a lot of people, rent an RV and travel to all the national parks in the world. I see people pursue, I volunteer as a board member at a nature center. We see a lot of people start volunteering or, getting into birding. What are you going to do with your time? A lot of people don't realize this, but this is one of the hardest things non-financially when it comes to retirement is, you connect a lot of your value and your personal identity to your career when you're working. So what does it look like after that? Okay. So lastly, consider, and I know this is hard and sometimes uncomfortable to think about, but how long do you think your retirement is going to last? Today's average life expectancy is about a decade longer than it was back in 1960. So think about, how long did your grandparents live? There's a good chance that you'll live as long or even longer than they did. Now, with that in mind, it's not a stretch to say that many people should be planning for 20, if not 30 years of retirement. So after the age of 60 or 65, right? Now, remember, your lifestyle, how you spend your time and where you live it could very likely change during that span of time, right? So the first 10 years of your retirement is probably going to look different than the next 10. And then, if there's more, the following 10. So it all changes, but it's just helpful to start conceptualizing thinking about this, right? So continuing on retirement, now, whatever you decide that you want your retirement to look like, the retirement strategy to get there needs to take into an account what the expected costs are going to be. Okay. Obviously, it is difficult to predict how much things are going to cost, for several years and years into the future. However, your retirement plan can include just an estimated budget. We can project out a reasonable rate of inflation to help give you a good understanding. Okay, so now here's an overview of how people in retirement are generally allocating their budget and where we see, a good amount go. The biggest thing typically is housing and things that are just related to basic expenses. What I tell folks when we're kind of putting together a retirement budget is, we need to plan for having a roof over our head, food on the table, clothes on your back, right? So when we're putting together a retirement budget, really start thinking about, that discretionary versus non-discretionary spending. Okay. With retirement income, based on what you can expect your, retirement budget to be, it's important to have different sources of income that are available to you. Okay. Now, sources of retirement income can include investment accounts. So like our 401ks, our IRAs. They can include pensions if you're one of the people that still gets a pension. Annuities, Social Security. There's a whole blend. So when you're planning for retirement, you need to start taking inventory of all of these different things and start piecing together, okay, well, what can I expect from this? How long can this last? How much does this one fluctuate? Once we've started to take an inventory of that, we can kind of put these things together. This is what we call the 4-box strategy. Now, it might look like a simple method, but I'll kind of just go into it. So let's kind of talk. We're going to break up our necessary expenses with our discretionary expenses. So when we look at it, our necessary expenses in the top right here, many of us have these that are going to be very similar to what we're showing here, right? So most people would consider expenses associated with housing, food, healthcare, essential or necessary expenditures. However, there may be some other things that we are or aren't considering, necessary. Now, to cover these necessary expenses, so this is like base minimum of your life, we should be looking at reliable sources of income to cover those expenses, right? So we're looking at Social Security, we're looking at pensions, we're looking at income annuities. The reason we look at those three things is because the distributions and the payments from those things are guaranteed for life, okay? Or at least we like to hope so when it comes to Social Security. Now, then we're going to kind of look at our discretionary expenses, right? So this is travel, this is hobbies, this is anything else under the sun that's outside of roof over your head, food on the table, clothes on your backs. This is where we're kind of looking at, income from assets. So this can be money in our 401ks, money in our IRAs. It's not guaranteed to last your lifetime, but you're sure going to hope it does. Now, when you're developing these strategies and these retirement income plans, you need to have this mapped out to a degree. It's never going to be perfect, but this is the general gist of this. Okay. All right. And then into our last section, we're just kind of getting to our time here. I'm going to briefly go over estate planning. I think this is hugely important for folks. Unfortunately, it's probably the most overlooked thing that I come across as, an industry practitioner. Now, to ensure that we have an estate plan, these are probably the biggest things, is having named and established beneficiaries and contingent beneficiaries on every account. I see this a lot. You should be reviewing your beneficiaries, I would say at least once a year, just purely because stuff changes, right? Some people get married, some people get divorced, there's deaths, there's births, there's estrangements in the family. I can't tell you how many times in my 9 years in the industry that I've met with somebody who had on all of their accounts still named as the primary beneficiary their former spouse, where if something happened to them, all their money would go to their former spouse. Estate planning is meant to ensure a smooth transition of assets to the recipients, right? If you do not have named beneficiaries on pretty much everything, your assets have to go through what we call probate. For any of you that have ever been there, I'm sure you never want to go back, but it's a lengthy, costly legal proceeding where the assets get distributed per the state laws, per what the courts say. And the cost of all the legal representatives involved need to get paid out of the estate. So one thing that I will echo, a will is not in any way going to avoid you probate. A will is instructions actually to a probate officer on how you want your estate distributed. Having named beneficiaries on every kind of financial account and even the deed to your home is hugely important. Okay. Some other things that are important with estate planning, having a will, I'm sure you've heard that before, having trusts. Now, trusts, they're not for everybody, but they are important. That could be its own topic. Life insurance and gifting come into a big portion when it comes to estate planning. You know, a lot of people are gifting behind large tax deferred accounts. So instead of having to drop that big tax liability on their children at their higher, usually highest income tax bracket in their life, what people will do is have life insurance policies to offset the cost of the taxes for inheritance. There's a whole strategy that comes into estate planning. It deserves more than the last 3 minutes of my presentation. So, so just in general, recapping financial well-being, you know, there's a lot of components, right? When it comes to saving, make sure that your saving goals are simple, attainable, and actionable so that you're able to stick with them. The earlier you start, the better. When it comes to investing, know that why you're investing and be realistic in your investment goals. Begin by understanding what your risk profile or your risk tolerance is. Protection. It's important to protect everything that you worked so hard to build over the course of your life. Retirement, it's an attainable dream. We just need to develop a strategy that's going to consider your goals, your objectives, and what you want it to look like and put you on the right path. Estate planning, it's important that you have some kind of a written plan for how you want your assets distributed after you pass away. All right, that's it. We did it. We made it through. I made it in I took 1 extra minute. So thank you all so much for attending our Kickstarter for 2025. This is going to be like an ongoing series. I'm working with my marketing team right now. We do have all the ones that we're going to do for the year. The calendar is just not out yet, so they'll get that out, but we're looking to do one of these every month, covering a myriad of topics. This one gave a very high level overview of a lot of what we're going to be covering throughout the course of the year. Okay. So I am a resource to you guys. Me and my team are, like I said, we're based in Milwaukee, Wisconsin. However, we hop on Zooms with folks all the time to chat. If any questions come up, if you're struggling with any kind of financial circumstances, do not hesitate to reach out. We do not charge anything for any kind of consultation, and we are fully licensed fiduciaries here as a resource to you. So thank you again. I hope everybody's year is off to a great start, and we will see you guys next month. Thank you again.